Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes.
Today, Stuart and I would like to talk about tax planning measures. We're coming up to 30th of June. It's a hot topic at the moment. What are the certain considerations you should be discussing with your accountant as we speak. And the first one is your trust minutes and company dividend resolutions and so forth. So obviously all that needs to be done before 30 June. This is where you would forecast your income for the financial year. You'd predominantly have most of your financial data now, given it is June. So it's easy to know what you're projecting to make for the financial year. And there you would determine how best to deal with that profit, whether it be sort of distributed to yourself, your partner, your children, your parents, or whether you will be paying out any dividends to benefit from certain franking credit.
The next thing to think about, at least is for us and many clients, is super contributions, because they need to be made before 30 June if you're going to make additional contributions. But most importantly, they've got to be credited to your account before 30 June. So most super funds want to receive those contributions by around 26, 27 of June for them to be included in this financial year. The concessional contribution cap is $27,500 per person. You have to subtract from that cap any employer contributions that have been made on your behalf during the financial year. And then if you have any insurances that you pay premiums on that are owned by super, so it's something you need to check with your accountant and financial advisor on, that also is included in the cap. But if there's a leftover unused cap, of course, you can make contributions up to that limit, and what you'll need to do is called what is called a notice of intent to claim, which is just a form that you give the super fund to tell them that this is a personal deductible contribution and that you intend to claim a tax deduction on it. Otherwise, they will treat it as a non-concessional contribution and you won't get the tax deduction for it. Finally, if your balance is less than $500,000, you might be able to use previously unused caps from going back 5 years. So again, that's something that your holistic accountant can confirm with you, but contributing to super is obviously a tax deductible expense and therefore will reduce your taxable income this year. So it's a great thing to do.
The next one is stock or work in progress valuations. So it's important to review what work or stock you have on hand as at 30 June. Given that everything's pretty much computerized these days, it's important to actually go through your physical stock or your actual WIP to determine what needs to be written off or wasted for stock before 30 June. So you're not actually inflating your stock or WIP values, which obviously will make you pay more tax for monies that you actually haven't received.
It is also good at this stage to forecast at least roughly what your taxable income will be for the year. Now, particularly if you're in business, this is important so you can forecast it across the group. And that'll inform you about if there's anything that you can do now before 30 June that's going to optimise that tax position. That could include prepaying expenses. To what extent do you make super contributions? Is there any income that you can delay receiving in June and get it in July instead, particularly if you're in business, if you've got a big client to bill or something like that? These are the sorts of considerations that we want to take into account, but those decisions are hard to make without the detail, which obviously means that you need to complete that forecast.
And finally, corporate beneficiaries. Now, they're a great tax tool where you can sort of park profits for other purposes. So instead of, for example, paying all your business profits out to yourself and paying 47 cents on the dollar, you can park some of those profits in a company and benefit from the corporate tax rate of 25%. Now, it's really crucial to know what you're going to do with those funds. Now, we see, unfortunately, that a lot of accountants use these corporate beneficiaries, but we end up with a whole bunch of Division 7A and unpaid beneficiary loans, which are interest-bearing loans, and there's no clear purpose on what the funds are going to be used for or how we're going to get those funds out at a later stage. So although a great tax tool, knowing what you're going to do with it is really important as well.
So there's some of the common things we're thinking about this time of year in regards to helping clients plan around tax. Of course, there could be additional things subject to your particular circumstances. So, of course, it's really important to reach out and have a chat to your holistic accountant about these matters. Until next week, bye for now.